Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture. Events after the reporting period, IAS 10. Now, the objective of IAS 10 is to prescribe when an entity should adjust its financial statement for events after the reporting period, and the disclosures that it should give about the date when the financial statements were authorized for issue and about events after the reporting period. The standard also requires that an entity should not prepare its financial statement on a going concern basis if events after the reporting period indicate or postulate that the going concern assumption is not appropriate. So let's take a look at the definition of what an event after the reporting period is. So these are events, both favorable and unfavorable, that occur after the reporting period but before the authorization of the financial statement. So normally, if a company has a reporting period of say 1st January to 31st December 2020, after the year end, it will take some time to produce the financial statement for it to be audited, after which the directors of the business will have to accept and sign, thus authorizing the financial statement for distribution to users or stakeholders. Therefore, it may even be up to the 17th of March of 2021 before the financial statement becomes available to the users. Now, although the financial statement should show the position as at the year end, that is, say 31st December 2020, amendments can be made up until the finalization date, which is the 17th March 2021 in this scenario. So let's take a look at certain elements in the definition that we have stated. The first is reporting period. So this is the time frame of which activities of financial statements relates or report on. It is normally 12 months for almost every business. The second element is authorization of financial statement. After the financial statement is prepared, auditors must check it for errors or fraud. If the directors agree to the assertions of the auditors, they have to sign it, therefore authorizing the financial statement to be distributed to users or stakeholders. There are two types of events that occur after the reporting period. The first is adjusting events. So this provides evidence to the conditions prevailing or existent as at the end of the reporting period, but were not captured in the financial statements. Examples will be settlement of an outstanding court case, bankruptcy of a customer, sale of inventory at below the cost, and what have you. The second type of event will be non-adjusting events. Now, these events do not avail any signal to the presence of a condition within the reporting dates. Examples are issues of shares, purchase of assets, fire, or any disaster. Let's take a look at the accounting treatment for both types. For adjusting events, the amount in the financial statement must be adjusted to reflect the condition. For the non-adjusting events, no adjustment or amendment is required. However, if the event is material to the financial statement, it must be disclosed. Otherwise, it will have an impact on the economic decisions to be taken by the users. Now, the disclosure must capture the nature of the non-adjusting event, the estimate of its financial effects, or a statement that such an estimate cannot be made. Let's take a look at some illustrations. Which of the following material events after the reporting date and before the financial statements are approved or finalized or authorized are adjusting events? The first is evaluation of property, providing evidence of impairment in value at the reporting date. So here, the evaluation happened after the reporting date. The evaluation is providing an evidence that the item or the asset had been impaired during the reporting period. It was not captured. So this is an adjusting event. The second is sale of inventory held at the reporting date for less than cost. If the item was sold after the reporting date but before the authorization of the financial statement at less than cost, this sale has thrown more light on the existence of the impairment of the inventory before the reporting date, so it has to be adjusted. Discovery of fraud or error affecting the financial statement. Now, this discovery also shows that the fraud or error was existent in the financial statement during the reporting period. so it has to be adjusted. Fourth, the insolvency of a customer with a debt owing at the reporting date is still outstanding. Now, the fact that the customer has been insolvent or bankrupt after the reporting date indicated or provided evidence to the fact that it was having financial difficulties within the accounting period. So a provision for bad debt should have been made for this customer. This is an adjusting event. So we now have to adjust and make a provision in the financial statement pertaining to this very customer. Fifth, the company makes an issue of 100,000 shares, which raises $200,000 shortly after the financial position date. Issue of shares does not in itself point to any condition existent in the financial statement prior to the year end. So this is a non-adjusting event. However, $200,000 being raised from issue of 100,000 shares is material. Or if it is material for the business, it has to be disclosed in the financial statement. Sixth, a legal action has been brought against the company for breach of contract prior to the year end. The outcome was decided shortly after the statement of financial position date, and as a result, the company will have to pay cost and damages totaling $50,000. Now, no provision has currently been made for this event. First and foremost, the moment the legal action was brought against the business, it should have assessed whether it actually breached the contract or not. Once it found it was likely to have breached the contract, they should have made a provision for it. That was not done. So the outcome of the court after the reporting date has provided further evidence to the need why the provision should have been made. So now this is an adjusting event. The financial statement has to be adjusted and the provision of $50,000 made. Seventh, inventory included in the account at the year end at cost of $25,000 was subsequently sold for $20,000. This has shown that the inventory had been impaired, but the business did not take cognizance of it. This is an adjusting event. We have to go to the financial statement and adjust the inventory down to $20,000 and provide for the impairment value of $5,000. Lastly, a building in use at the statement of financial position date and valued at $500,000 was completely destroyed by fire. Unfortunately, only half of the value was covered by insurance. Here, the fire occurred after the reporting date. I don't know which condition this information is going to point to prior to the year end. So this is non-adjusting. However, the building that has been burnt is material and the recovery of only $250,000 should be disclosed in the financial statement. So guys, this is where we'll bring our discussion on events after the reporting period to a close. If you have anything that beats your understanding that you want us to throw more light on, you're very welcome to drop them in the comment section below and we'll be more than glad to try and resolve it. Whilst at that, do not forget to click on the red subscribe button, click on the notification bell by it, like and share. So we come to you once again by way of tutorials on the go. Take care of yourself and stay blessed. Poker.